So I was struck by the sort of disconnect that exists here between the behavior of unemployment and inflation. You seem to have unemployment penciled in here now for 3 years running more underneath the longer run level, yet inflation never really accelerates. So what are we to make of that?
Well, that's what's happening there is the fact that the relationship between resource utilization or unemployment and inflation has just gotten weaker and weaker over the years. If you go back 50 years, you would have seen that when labor markets were tight and unemployment was low, inflation moved right up. And then as the Fed got control of inflation, the connection got weaker and weaker and weaker to the point where there's still a connection, but it's a very faint one. And what that suggests is that you would need to keep policy somewhat accommodative, and we believe that policy is somewhat accommodative. And we think that that's the appropriate place for a policy to be in order to drive up inflation.
Follow up on that. I mean, it's faint and non-existent, though, it seems to me. So this suggests that really your policy lever as it exists now isn't really influencing prices at all. So in that case, what do you do to reach your target?
Yeah, no, I don't think that's right. I mean, again, the relationship between slack in the economy and inflation is weak, has been weak. The coefficient is something like 0.1, so it's much, much lower than it used to be. But I don't know that it's gone down any more in the last decade. It just is quite faint, but it's still there. I mean, you can see it if you look at where wages were 3 or 4 years ago. They were running around 2%, and now the whole group of different wage measures that we monitor has moved up to 3 and 3.5%, and that suggests tightening. The same thing is true, but much less true of inflation. The relationship between, in a way, the wage Phillips curve has a higher coefficient than the price Phillips curve does. But we do still see some relationship, and that's what you're seeing in those numbers.
Mr. Chairman, Steve Leisman, CNBC. You've used the analogy to 1998 to describe the rate cuts we just went through. And I'm wondering if we can sort of continue the analogy. Within 7 months of those 98 rate cuts, the Fed took them back and then some. So were those kind of rate cuts the kind that you need to take back? Or are we at a place now where we're at a neutral rate? Take back, I mean, if those risks that you say we're cushioning from don't materialize in the way you think. Or is this now a new sort of steady state for the economy at this rate? This is the right rate for the economy that you see going forward and don't need to take those rate cuts back?
So there's similarities, conceptual similarities, I think, between the two instances during that long expansion, I guess in 95 and 98, when the Fed cut 3 times only to resume raising rates. And the notion just is that the economy needed slightly more accommodative policy, but it wasn't the end of the expansion, right? And that's the same situation we believe we're in here. So we did in fact turn out to do 3 rate cuts. That wasn't in the plan, in any kind of specific way at the beginning. So that's the same. What's different is you have very different structural characteristics in the economy, particularly around inflation. So now, as you can see, inflation is barely moving up, notwithstanding that unemployment is at 50-year lows and expected to remain there. So the need for rate increases is less. And by the way, it's a good thing that we think I think we've learned that unemployment can remain at quite low levels for an extended period of time without unwanted upward pressure on inflation. In fact, we need some upward pressure on inflation to get back to 2%. It's quite different in 95 and 98 when there were those two adjustments. So I would say similarities and differences.